let's take a look at the shareholders equity section of a balance sheet for a corporation. When we had a sole proprietorship, we had just one owner's equity account. It was called owner's capital. Then when we looked at partnerships, we had an owner's capital account for each of the partners. Now we're going to have an equity section. It's just going to be called shareholders equity, and it's going to have a little more detail. So instead of just a total of the capital account, we're going to break it down to show people what the shareholders paid in when they bought our shares, money that we've earned on their behalf but have not paid out in the form of dividends. That's called retained earnings. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And we're going to show people how many dollars we gave back to our shareholders by buying back their shares. That's called treasury stock. So there's really three basic sections to the shareholders equity when we're talking about a beginning accounting class. There's the paid in capital, that's the money the shareholders gave us. There's retained earnings, that's the money we retained in the company. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And then there's treasury stock. So these other accounts all have credit balances. Treasury stock has a debit balance because we bought back shares from our existing shareholders. So the paid in capital is going to have two sections within it. The par value, which is meaningless as far as common stock goes, but meaningful as far as preferred stock goes. And so whenever we sell shares, the par value will go into that account. If stockholders paid more than the par value, those extra dollars will go into additional paid in capital, sometimes called paid in capital in excess of par. And as you can see, they paid a little bit more for the preferred stock and a little bit more than par for the common stock. And then there's retained earnings. Retained earnings at the beginning, plus net income, minus dividends gives us retained earnings at the end. And treasury stock is when we buy back our shares. All those other accounts have credit balances. Hopefully retained earnings has a credit balance if we made money. But treasury stock has a debit balance because we bought back shares from our shareholders. So you add up the paid in capital, that's the money the shareholders gave us. Retained earnings, that's the money that they pay, that we've earned on their behalf. And you subtract out the treasury stock, those are the shares we bought back, to give you your total shareholders equity. All right, I hope that helps.